So here we have what we were expecting with that bigger drop as we got to post-Thanksgiving. But this one was a bit larger than what we had in mind, especially, and it was really driven by diesel. And diesel had that big drop, so we do expect to see some of that recovery as gasoline, flatlines for one more week or starts its kind of downward trend. But just based on some of the Gas Buddy data, some of the other data out there, we expect to see this stay fairly flattish until we see a little bit more of a dip as we go forward. And when you just look at the chart here and just, again, comparing the 4-week rolling average versus other, it's important to appreciate kind of where we sit right now. What are some of the adjustments? So when you look at the current, which the current week it came in at 14.27 million barrels a day versus last week's of 15.124, we just expect this to shake out on a 4-week rolling average much closer to about that 14.9 level. So just below that 15,000 mark. As we go into year end, we will see some of this accelerate, but it's going to come down to what is demand based on weather, what is demand based on diesel. So heating oil demand will continue to be lackluster just as we have a decent, relatively speaking, heat wave coming into the Pad 1 or the East Coast, which again, we'll see this kind of bounce back up. But here you can see that drop, and then we'll see a little bit of that recovery, but again, holding just beneath that 15 million barrels a day. Now, the November loadings of shipments of clean fuels from Asia to the Americas continued to rise, as we were saying, to about 150,000 barrels a day. That will continue to move forward as we do get some cuts on pricing in the physical market and some increases, but we'll touch more on that as we go into segment 3. So then when we turn to the specifics, distillate had a build of 2.73 million, brings us to just 10.1 million below the 5-year average. We had builds across the board except in Pad 3, which had a small draw of 1.71. And you can see that on Pad 3, that brings us 2.6 million below the 5-year average. But Pad 1 is closing that gap. So we had started initially with Pad 1, 12 million below the 5-year average. Now we're just 7. This is where it's going to come down to weather based on where we sit at this point and just where the weather is expected to be through the 17th and really through the 21st. We should start to see this continue to build much closer to the 5-year average. Imports, as we said last week, would accelerate. They were up just 36,000 barrels a day, 36,000 barrels a day, but bringing us 102,000 above the 5-year average. And we see this staying fairly elevated as we go through the remainder of the year, where we'll just be just above, again, that 5-year average. Then when you look at the chart in general, the pace of builds remains right in line with the 29-year average, but just at a reduced level. So we just think that you're going to continue to see that move up, because typically you start to see this drop and then it goes sideways, where just based on where demand is right now, based on weather, based on where diesel's shaking out, heating oil and diesel, we expect this to get closer to the 29-year average and really not see this dip, but see a fairly steady move up. Not a huge increase in like a big rate increase or rate of change in stock builds, but just kind of a fairly flattish move higher. Then when you look at demand, we were expecting a further drop to the 5-year average. You can see that we went right through it, but we stayed elevated, and we thought we were going to get one more down move before we get this big up move. And you can see just the volatility. We're still within the bottom. We're still within the cloud, just below the 5-year average. So we do expect to see a nice spike up. It's just it won't be as good as in the past, just because the heat wave that's coming through is just going to minimize some of that demand in general. So headlines coming across now: European imports of fuels like diesel and jet from India will fall month over month in December. But again, we'll talk about that more in segment 3. So then when we look at the truck stop demand in terms of trucking demand, as we were saying, we expected to see a nice bounce in loadings. And here you can see that we had a little bit of an increase, came to about 123. We expect this to continue to just grind higher. Again, not a huge surge back up. but still come to about that 130, 135 level. As you can see, rates continue to creep higher. Even though diesel's coming down a bit, a lot of that is now just being kicked into the labor side, trying to increase wages and incentivize people to come for, again, that long haul shipment. Now, when we look at rail traffic, got a nice little spike. Total car loads were up 3.9%. Now you can see that we're above 2020 across the board for, grains have picked back up. That'll stay elevated. Forest products, farm products as well. Again, motor vehicles will remain soft just based on the issues in terms of supply chain, assembly lines. Non-metallic minerals will remain strong. Coal remaining strong. Petroleum products starting to climb a bit higher. That's something that, again, trying to shift more from pad 3 into pad 1. That's something that will remain in play. And then intermodal starting to close that gap as we've been saying, or at least hoping for the last 2 to 3 weeks. But you're just going to see that level off. We think that the gap will continue to tighten and get closer to about 5 to 6% below last year. But again, you're still seeing those units continue to move higher. So when we look at Signal, now you can see that there's some of the shipments are starting to slow a bit, but it's going to come down to classification, because you pay for demurrage, you pay for ships that are waiting to get to port. So we're starting to see what's called slow steaming. And so that's going to pull down some of these numbers, but it's still going to keep a lot of things elevated along the coast. And there's been a mixture of companies like, look, I'm not paying for you to dance, to sit there. And now when you look at the port after you had the oil spill, it's a matter of, well, how about you continue to cycle a little bit further away from the coast? And that's when you start looking at loitering or slow steaming further offshore has increased, while anchored or loitering within 40 miles has come down. So when you look at the total number, it's still very elevated. It's now going to be a matter of how do you calculate it. And that's going to be something that we're going to continue to look at, as things may appear a bit better, but when you dig in a bit more, it's still just the same. It's just a matter of where are they and how are they being counted. Now, as we talked about some of that heat wave coming through, you can see that things heat up post today and continue to grind higher a bit. It's just going to, and when it's really from the Rockies over into the East Coast, remain well above seasonal norms. That continues. This goes out for till the 17th, looking into the 21st. It looks very similar. So again, this is going to reduce some of that heating oil demand. It's going to enable some additional builds, and again, trying to close that gap that we've seen form in terms of heating oil and diesel demand. Storage rather. Now, when you look at gasoline had a bounce of 3.88 million barrels. That brings us 12.1 million below the 5-year average. So the gap has actually widened a bit in terms of the 5-year average, because when you look at what happened in 2020, when you look at some of the others, you had a big acceleration into year end. And now we believe the pace is going to continue at this rate, but it's just not going to be a huge surge, which as we go closer to the end of the year, we're just going to close this gap a bit further, but not get right back to the 5-year average. Pad 1 had a build of 2.25 million. Oh, I should say there was a build across the board, except Pad 5 had a small draw of 90,000 barrels. So again, you're seeing something fairly stable across the board. Imports dropped 87,000 barrels a day, and getting closer to what we were saying of about 500. We came in at about 557,000. That's 49,000 barrels a day below the 5-year average. We just think that we flatline at this rate, and we're going to be very close to the 5-year average, either just below, just above, and it's just going to. We did get some builds in gasoline in Europe. We're starting to see that increase a bit, so that will open up the arbitrage, and we'll see some come into the U.S. But here we do expect this to continue to grind higher on the storage side. And then as we said in segment 1 about the EPA, the U.S. Environmental Protection Agency on Tuesday will reduce ethanol blending volume mandates to account for the impact of COVID on fuel demand and reject a significant number of small refinery exemption requests, two sources familiar said. And again, the ethanol mandates will be around 12.6 billion gallons for 2020, 13.8 billion and then 15 billion for 2022, 13.8 for 2021. So again, you're starting to see some of these adjustments. It's going into comment period, so this is going to be something to watch to see where are some of the impacts on gasoline, blending components, as well as ethanol. And then when we look at blending components, which as we always think of is important, of what is demand going to look like going forward. Blending components had a big build of 5.15 million, and that's now 4.4 million below the 5-year average, and we see that continuing to grind up. And when we look at production rates, even though we had an increase of 1% of refinery throughput, production of gasoline dipped 3.4%. And and distillate was essentially flat. So this is just a matter of timing and what process was being used, what was being implemented. Refinery run rates can increase, but it may just be into what part of the process. So we do expect gasoline production to increase again, and the production of distillate also remain elevated. So then when we think about where we are, even though we had a big dip in production of gasoline, that's still right in line with the 5-year average. And then we're right in line with the distillate 5-year average as well. Now, coming back to gasoline, gasoline had a nice little demand, had a nice little pop. According to Gas Buddy Weekly, Sunday to Saturday, U.S. gasoline demand jumped 3.3% to the highest since the week of August 22nd, and it was 2.4% above the 4-week average. That was a nice little surge, and it's something where we think it comes down a bit, but still remains fairly strong versus where we've been previously. It's just going to normalize a touch as we kind of come into these dog days between Thanksgiving and Christmas. I know for us, we've had a big increase in some COVID cases, again, post Thanksgiving. The fact that it's gotten colder and things are spreading the way you would expect they would in winter. So that'll put a little bit of a damper, but again, still keep things fairly stable. Now, when we look at gasoline prices, gasoline dipped about just below about 3.9 cents, bringing us to $3.34. Still very high, but again, starting to normalize. We expect this to flatline a bit. It'll come down a few more pennies. We expect it to come closer to about $3.30, but still then, just based on where crude prices are, based on where refiners, what they're operating at, there's still enough to keep that fairly well bid, just around $3.30. Now on the diesel side, we had a drop of about $4.6 cents. Went from $3.72 to $3.674. And this is where you'll start to see this normalize a bit. It'll weaken a touch, but again, coming much closer to about $3.65. But just the pickup in diesel demand will be enough to keep us fairly elevated, especially on the trucking side. Now, when you look at blending components, here we had a nice spike, and seasonally speaking, it's very normal. We just expect it to maintain this pace, this is why we think we'll get much closer to where we closed off the year in 2018, 2019, and 2020. So really nothing too much of an adjustment. Gasoline demand on the 15-year average, we're right at the 15-year average. Really, not much to say one way or the other, but fairly stable. And then when we zoom in a bit on the 5-year, you can see that we're right. We normally see a little bit of a pop. Typically we get another sizable move up. We just think that we get a little bit of a little less of a move higher, which again is going to adjust that rate a bit and be a little bit closer to where we were in 2016 versus where we were in 2019. But you can see right now we're right in line with where we were in 2019 and just above where we were in 2016. But the next 2 weeks will kind of indicate where are we going to peak, how much are refiners going to try to implement and the blending side as well as the retail side, trying to make sure that there's enough gasoline for that final push into Christmas. When we look at activity levels, you can see that things got right back to normal. Workplace transit post-Thanksgiving. Residential staying a little bit elevated, and when retail recreation's coming right back into where you would expect it to be. We just expect a little bit less activity on the workplace side and transit as more people opt to stay home, work from home, to mitigate against some additional exposures, as we have some case creep throughout the U.S. Mobility trends came down, but again, starting to normalize closer to baseline. We don't see that adjusting. We see it just staying right around these levels as we, coming down maybe just a touch, but again, very much along the lines of a seasonal norm. Propane had a small build of 610,000 barrels. That's still 9.7 million below the 5-year average. You can see here, we expect this to now start to accelerate to the downside, but because things are getting a bit warmer, especially in where you would see a lot of consumption for heating and other domestic use, that'll adjust the pace in which it comes down, which again will flatline it a bit and put it in less of a bullish fashion. But when you look at the days in supply, you can see that days of supply is now at a new seasonally adjusted low. We will get a little bit of a pop higher, but this is why it's important to look at, well, what is storage and then what is demand? And you're starting to see that demand still remain strong. Even though supply is ramping up, there's still strong demand, and we do expect to see some of that normalizing in exports, as we talked about with Asia, opting to move a little bit further away from the U.S. and for the Middle East, and buying a bit more from the Middle East due to the issues at the Panama Canal. But that's something that we'll talk about a bit more in segment 3. People vaccinated continuing to grind higher. Not much has changed overall, with a lot of areas falling within that 70%. India continuing to climb. Again, these are all positives in terms of mitigating the severity of some of these new variants. We were expecting a drop closer to about that 1.4, 1.5, but we were also surprised at the bigger spike. We thought there was going to be an increase, but not something as elevated. So now you can see a bigger drop in general in terms of coming back lower. And then when we look at what happened on the builds, if we had a build, we had a small build of 640,000 barrels in jet fuel, which brings us just still at that 3.2 million below the 5-year average, so still very stable. We expect to see this pop back up and settle in at about that 1.5 million. And continue to sit there. We'll get one more move up just based on, again, the Christmas move, but we'll still average out just below that normal level. When we look at global flights, you can see that we're getting a little bit of an increase in North America as we head into year end and the holidays, where Europe has seen a steady decline. And then rest of the world has continued to grind higher. Asia Pacific still low. We don't see that adjusting, and so between Europe and Asia, that's going to keep us low as North America remains a bit elevated. The average number of departures per day increased by just under 2.4%. Departures in the U.S. and China led growth, while Germany and Austria led declines. Now, when we go forward globally, the passenger flight schedule for the 11 weeks ahead has declined 2.8%. While cuts are slightly higher than normal, the Omicron variant has not yet really adjusted too much. China led cuts in the short term. Europe and the U.S. led cuts in January and February, while the Christmas period was relatively unchanged. So we're just going to get that seasonal lull that normally happens in January and February from Europe and the U.S. And as we've been saying from the very beginning, and by very beginning I said in March, we were expected this to climb back up and follow the seasonal increases and then remain just below that seasonal norm. So typically we're at about 2 million passengers right now, and we're sitting at about 1.459, so about 500,000 below normal. We expect that to remain as we go forward, of about 500 to 800,000 below normal, depending on the period in time and how it lines up. But again, just below what is normally happening at this period and this time of year. Open table, seeing some additional pressure on a global basis, and that's because of the problems in Germany, and then the spreads that we've seen that are putting some restrictions in terms of the UK, Ireland, Germany, and other pieces of Europe. So we expect this to increase just a bit, and demand for during the week to fall to about 15% below normal, but the weekend still holding in at about a 0% to 5% change versus what is historically normal. So that's what we have for you for the updates in the US. And now in the next segment, we're going to go a bit deeper into what is happening in the global market and how have things changed and what does the OSP indicate and what do we think is going to happen as other countries come out and give what their official selling price will be.